October 31st, 2023. We got a couple measured moves up today. First one, this is a wedge, essentially. It's an attempt at a wedge, and that was where we got that pullback. I think the more, useful one is when you start to get a breakout of the 18 bar range and the trading range in general. It's reasonable to think you're going to get a measured move up of that trading range. We came up one tick short, but or two ticks short, but it's close enough that it's considered tested. And that's what we were doing here. So if you're long for any reason, and then you get an inside bar like 69, it's an II pattern, inside bar 68, inside bar 69, traders are going to exit below that. So you can see we actually just made another attempt at that high. We missed. Strong bear bar on bar one. If you look at the context for the past day or two, or really yesterday, you have a strong bull trend, and then a trend line break, and then a lower high. So it might be a lower high major trend reversal on bar one, but it's usually hard to want to trade bar one. It's just too early in the day. There's no reason to trade so early in the day, and you end up getting big follow through on bar two. But there's a tail on the bottom, and the tail on the bottom is really important. It tells you that bears are scalping down here. So if you got a really strong close on bar two, a lot of bears would have sold, expecting at least a scalp and for us to close breakout points. And that's what this whole thing was really. Since this is a trading range, traders are expecting breakout points to close. And you can see here yesterday, we got a strong breakout above this breakout point, and it never really got tested. And so that's what we were testing around on this opening move down. You get an inside bar on bar three, and it's pretty disappointing for the Bears. The Bears they wanted two to close strong. They wanted a big bear bar on three. Instead, they got a weak close on two, and a doji bar, or not a doji bar, but not a strong bear bar on three. And so what's happening here on four is a lot of those bears are buying back their shorts, and that's causing this rally. It wasn't a big rally, obviously. There are going to be sellers above three, but that's what's happening there. Five, bear bar, but not closing very strong. You can see traders sold below the low one on four, but they all pretty much scalped. I don't know if they made 5 points. They did not quite make 5 points. They're a couple ticks short. And you can see basically we traded down and tested that breakout point. And so five was just a vacuum test of this breakout point and got bought up. Six is an inside bar and doji. This bar six was on its high for most of the bar and then ended up getting sold off in the last couple of seconds. So what's happening on seven is the bulls who were front running this, they were hoping that this was going to close strong on its high. And some of them started scalping out, and then it closed essentially as a doji bar. And so when that happens, a lot of the bulls are going to sell to their longs, and that's creating bar seven. Bar seven is interesting. This is essentially an attempt at a wedge, like I was saying, by the bulls. But if seven can close below five, it's closing below the wedge and it's closing below the breakout point. So it's reasonable to think that if seven closes strong, we might sell off for a measured move down, or at least to this breakout point and potentially further. But bears were unable to get the strong close on seven, and there was a tail on the bar. And when that happens, any of the bears who were front running this, hoping we were going to get follow through, or all the bears who were selling in here for any reason, looking for a reason to stay short, are disappointed in seven. They're thinking this is probably a trading range, and they start buying back shorts. And when traders buy back shorts in a panic, you start to get big. You'll get a big bar like this. The kind of same thing was happening here. But you'll get a big bar like this when traders are buying back shorts in a panic because the breakout failed. So you get a failed breakout. Traders are disappointed, and they're buying back shorts in a panic, and that causes eight. And eight did something really important. You can see from 3 to 7, it's a tight trading range, essentially. We have, at least 2, maybe 3 dojis in here. No strong trend bars at all. And so it's a tight trading range. And when you get a tight trading range, generally it's better not to trade, but 8 closes above the high of the tight trading range. So it's really different than there was similar things that happened the other week. Like over here, this is a tight trading range, but we don't close above the high. We don't close above the high. There's a really good example a couple days earlier. Here, we're in a tight trading range on the open, and you get a good bull bar. Yeah, maybe it's always in long, but we're not closing above the top of the tight trading range, right? The tight trading range starts here, and the bottom's here. So we need to close up here, and you need better follow through for the bulls. And so with 8 closing above the high of the tight trading range, it makes it a more appealing buy. Bulls buying above 8, they know it's a swing trade. And what they're essentially more or less hoping for is that, we have a strong rally, a two-legged correction, and we're going to get a big second leg up. And we did end up getting a second leg up. I don't know if it was an exact measure move. I haven't looked at this yet. It probably wasn't. It's this here. Yeah, we got close, but we didn't quite get there. I think that we oscillated around, I mentioned on the daily chart the other day, I thought we were going to get back to this low, and limit order bulls were going to make money. And you can see we basically touched that low. The low is 42.13.25. And so it needed to get to 42.13.50 for those limit order traders to make money. And we got to 42.15, and then it just oscillated around that price for the remainder of the day. So I think that's the target that traders were looking for up there. But that was just a side note. Follow through for the bulls on 9, but there's a big tail on the top. Why is there a big tail on the top of 9 if this is going to be such a strong bullish move and a good second leg up? Then why is there a big tail on top of 9? Similarly with 10, if you get 9 with a tail, it's not the end of the world. It's still okay to be long, and you want 10 to be a strong bull bar closing near its high. And then 10 is essentially a doji bar. It's a bull close, but you have big tails on 9 and a big tail on 10, so it's forming some sort of micro double top on a smaller time frame, potentially even a wedge if you get another tail on the next bar. So a lot of traders are really disappointed in 10. And then you get an inside bar on 11, and I think a lot of bulls are going to exit below the inside bar because there's too much risk that we're going to, essentially get a vacuum test of the 7 high, which is what happened. But a lot of bulls are going to exit below 11. Bears who sold below 11 get disappointing follow through, but it's a bear close on 12. So with the bear close on 12, there are probably more sellers above than buyers. If there's a bull close on 12, bulls probably wouldn't buy, but there's a low probability that you're going to start to get a breakout, and then you're going to end up getting the big second leg. But if you did start to race up, traders would be worried it's 1, pullback 2, and it's a second leg trap. So, but the bear close is disappointing for the bulls. So 13 is an outside down bar. It's a micro double top. You're selling the overall top of the trading range. When you're selling 13, there's a 60% chance we're going to get to this high. Generally, when you take a reasonable sell, if you're a bear, you sell above this high. You're disappointed in 8, but some traders will scale in higher, knowing there's a 60% chance they're going to get back to their initial entry price, and an 80% chance they'll get to the midpoint of this high and the low of the next reasonable bear bar, which is this. So 80% chance we're getting here, 60% chance we're getting here, and 40% chance you'll get a big swing down and maybe a measured move down of the opening range. You end up getting big follow through for the bears on 14, but the tail on the bottom is a problem. When you get a tail on the bottom of a bar that's testing a magnet, a lot of traders are going to see this and they'll see that, well, we got there, but traders scalped. And so when traders are scalping out on the low of 14, guess what happens when 15 opens and tests that price again? The traders who aren't out yet, who held hoping that this was going to continue down, a lot of them start scalping out, and that starts to drive the market up on 15. And as 15 starts to race up, traders realize that, if you're holding through the close of 14, your premise is that we're going to collapse, right? Your premise is we're going to get some sort of measured move down. And if we're going to get that measured move down, it's probably going to start with a pretty big couple of bear bars. But as 15's racing up, your premise becomes less and less valid because you're thinking that we're going to go down here, and instead we're going up here. So how valid is your premise? And if we trade above 14, like we did, traders now will, try to think about the scenario where we trade above 14 and then suddenly reverse back down on 15 and collapse. It seems super unlikely. And even if that happens, it's 1, pullback 2, and then it would be pullback 3. So it's possibly a wedge. So once 15 goes above 14, a lot of traders really don't think their premise is valid, and they start buying back shorts in a panic. And that's what drives the market all the way up here. You often get these big bars in trading ranges for basically that reason. So when we start to get up here, traders buying back shorts, driving the market up. 16, bear bar closing near its low. You could argue 1, pullback 2. So this is a second leg trap, and traders are hoping to sell below 16 for a swing, but it never triggers. Bulls buy the close, looking for another leg up and trying not to let it trigger because they know the other bulls will exit below 16. And you can see on 17, we essentially got 1, 2, 3, and we got 3 legs up. And we got a breakout to the upside of the daily range, but there's probably sellers around yesterday's high if we get there. So it's really not all that good of a buy above 17 because, like I mentioned, it's 3 pushes up to the top of a trading range, and you're probably going to get a failed breakout of yesterday's high even if you go up. Does this look like really strong bull price action with all these big bear bars? Probably not. So 18 failed breakout above 17, 90% chance we break out of the 18 bar range. So we should go at least a little higher. And then you can see on 19, bulls who bought above 17, disappointed 18, are exiting at break even during 19, and that drives the market down. You get an inside bar on 19, and it's an interesting bar. There's logic to selling it. Sorry. There's logic to selling below 19 for a swing. But if you're going to sell below 19, what are you hoping for, right? Well, you're hoping for at least a vacuum test of the 14 high. And you're really hoping for a breakout of the 18 bar range to the downside. So you're looking to make like 20 points, risking 5. And it just doesn't quite close as strong as you want. And it's not quite what you want, which is pretty common in trading ranges for things not to look, all that great. And if you do sell below 19, what do you think when you see 20? If you sold 19, what do you want to see? You want to see a bar like 1. You want to see big follow through to the downside, and you want to see a bunch of bulls get trapped buying below 19. Did they get trapped? No, they didn't. The bulls who bought below 20 are fine. Who bought below 19 are fine. They're probably happy with 20. So what happens is the bears who sold below 19 are disappointed in 20, and they start buying back shorts around break even, and that causes 21 and the micro double bottom. However, bears don't really want 21 to trigger because it's a micro double bottom. There might be buyers above, but probably not. But you're in a at the top of a trading range. So a lot of times you'll get moves like this. And it's a bear bar on 22, but it doesn't close very strong. It's just potentially a 2-legged pullback in a broad bull channel. But you're at the top of a trading range, so better to just be flat. 23 follow through for the bears. It's 1 pullback 2 though. So if you look, 22 went down and then pulled back and closed, and then 23 went down. So it's a 2-legged correction. And you could argue that it's 1 pullback, 2 pullback, 3, but all the tails on the bottom, are adding extra pushes and stuff. And that's what happens in trading ranges. Usually you're going to get really confusing bars and confusing moves in general. And that's why they're trading ranges, because, neither side is clearly in control. 24, probably sellers above 23. You can see anyone, trading ranges are super forgiving to traders who scale and use wide stops. Even if you bought the close of 21 and got trapped, you can see on 24, you were let out at break even. That's why when we got up here, for one, traders are going to sell above 23. They'll sell a couple points above 23, but a lot of bulls are exiting at break even here, and that's what's causing 24. I'm so tired today. But 24, 1 pullback, 2 pullback, 3. So it's a third push if you're selling 24. So it's really not all that great. You can see the traders who sold 24 get trapped on 25. You could argue to buy above 25. It's the bottom of a broad bull channel. 3 pushes down, you have trap traders who bought below 24. But I don't think it's all that great to buy above 25. It's, if you think about it, how often do you really get an explosive breakout to the upside after 25? Not very often at all, maybe 20% of the time. So more likely we're going to get, a more sideways move. Even if you do make money, it's probably going to take a while and it might trap you out. So anyone who bought above 24 was taking or 25 was taking a chance we were going to race up. And when we don't race up on 26, they all sell out of their longs on the close of 26, and that's what's causing 27. 27 tests the 14 high. So there were traders who sold the 14 high, scaled in higher, and 27 tests that high, and those traders are getting out, and that's what's causing the tail on 27. Inside bar on 28, but not all that strong. You're in a bear channel, an overall bear channel, but you're at the bottom of a broad bull channel. And again, this is the problem with trading ranges, is that you can draw channels, but you can also draw channels within the channels. So it's hard to want to, do anything on 28, 29. And then you get a big bull surprise on 30. And when you see 30, it's easy to think, well, we're definitely going to rally here. But it's just 1 bar. And, if you look at the big 1 bars, so far today for the Bulls. Big bar on 15, bad follow through. Big bar on 17, bad follow through. Big bar on 8, some follow through, but it ends up being disappointing. And we still end up testing this high, and then later we end up testing this high. And so, what do you think is going to happen with the traders who sold above 29? You think they're going to stay trapped and they're just going to take a big loss? Probably not. It's probably a trading range, and it seems like the top of the trading range. 30 might just be a vacuum test. So we're probably going to get back to this high. And so a lot of traders, most traders aren't buying here. For most traders, this seems like a great place for bulls to take profits. And that's what causes 31. It's a one-tick trap. 31, it's a potential bull trap. You still haven't broken out of the 18 bar range yet. And so I think a lot of traders might sell below 31, taking a chance that we're going to get a big collapse. Bad follow through on 32. And 32 is more important than a lot of people think, because once you get the big bar on 33, the big bear bar closing near its low, you're now worried that it's 1, pullback 2, and this is a second leg trap on 33. Obviously, still okay to be short on 33, but 34 does something important. Essentially, this is a wedge, right? So you can see this whole thing is a wedge, and bulls tried to make the wedge work, but it failed. So when the wedge failed, traders wanted a breakout below the wedge and a measured move down of said wedge, which, no surprise, is to a new low of the day. So that's why, another reason, again, adding reasons why it makes sense to sell below 31. You're getting a measured move down of the wedge is right to a new low of the day, where a lot of traders would be waiting to buy back shorts. And then you get 33, and we might race down, but 34 fails to break out below the wedge. So traders who sold below 33 were hoping they were going to get another big bar like 33, or at least to close below the low of the wedge to confirm that we've broken out below it. But the breakout ends up failing on 34. And so on 35, bears see that the breakout failed and they're disappointed. Some traders even sold the breakout. They'll sell one tick below 27. And then you can see once on 35, once we got back to that one tick below 27, bears buy back shorts. Once we get back to the entry price, again, for 33, bears are buying back shorts. And that creates an inside bar on 35. It's 2 legs down. It's an inside bar of 35. You could buy above 35 for a swing. And that's still 90% chance of breaking out of the 18 bar range. In trading ranges, the best trades often look really sketchy. And I think this is a good example of that. It's a small bar, but the context of the failed breakout makes sense. You might have some trap bulls, and 60% chance we're at least getting back to this low. So I think it's an okay buy above 30 or 35, taking a chance that we break out to the upside. You get some follow through on 36, and we touch this low and find some sellers. And then you get big follow through on 37, which any trader, even if you bought the 30 high, as long as you were willing to scale in more below 30, you were able to get out around break even on your first entry with a profit on your second entry. 37 has a big tail on the top of the bar, so that makes some traders wonder if we're going to get another failed breakout attempt at the 18 bar range. That's one of the reasons why we start to go down here. But you can see once we get below 35, weak bull stops are below 35, right? If you bought above 35, your stop needs to be below 34. But, weak bulls will put their stop down here. And that's exactly where we went there, where strong bulls or smart bulls, whatever you want to call them, are buying more down here. And that's what's causing this rally up on 38. 39 breaks out of the 18 bar range, but it's just really not impressive. There's a giant tail on the top, and just all these bars have lots of overlap. So we get the breakout, and we broke out of yesterday's high too, but we failed at yesterday's high, and we failed to break out of the close above the breakout of the 18 bar range. So really not very strong. 40 bull bar, but you can see the buy never triggers. And there was never really great buy the close in any of this, and that's one of the reasons why it's able to just continue to grind up higher. Is because the buys don't always look all that great. And so traders keep trapping themselves out, and they have to continuously chase the market up. And that's what continues to cause the rally. 40, for channels like this, on days like this, it's better to buy below bars, right? There were buyers below 40 during 41. You get follow through for the bulls on 42, but again, a big failed breakout 43. And then you get 44, and it's 3 bull bars, but it could be 1 pullback 2. So problem is it could be a second leg trap. And even if we are going to go up, how much further are we really going to go up? this is essentially this whole thing was a wedge, or a triangle. I think this channel line is pretty accurate, and there was an overshoot here, which happens sometimes. But 45 trades below 42. If you bought above 42, your stop's probably below 41. So because that's the last major high or low, so weak stops once again get run, and strong stops do not. If you bought the close of 44, probably not in love with 45. Hence why when you get 46, 47, testing the 45 close, you find sellers. It's a double top, probably buyers below. You can see we got buyers below 47 during 48 and a reversal up. Good follow through for the bulls on 49, but we're probably going to end up overlapping this high. There was an open body gap, but there was so much overlap, I think, during the day that it's hard to put a lot of emphasis on one open body gap. But it did stay open with this, and it stayed open with we never got a close below that piece of the 18 bar, or below yesterday's high close, essentially. So it was still a decent open body gap, but on a day that's so range bound, it's really hard to want to use that as a reason to buy. A double bottom for the bulls on 48. You know that 47 is a bad sell. It's a doji bar, so probably buyers below. See, there were buyers below. 48, it's a high two, probably sellers above. And you can see, even if you sold above 48, scaled in on 50, it heads back to your entry price. So those traders, it didn't quite, you let them out, so some still got trapped. But if a lot of traders who sold here and sold more higher were able to make money. 51, more follow through for the bulls, probably sellers above here. You can see 52, so traders sell above 50, sell more higher, get out during 52. That's what's causing part of the rally on 53 is bears buying back shorts. Some bears will, traders will sell above breakout points, betting that we're going to come back and test the breakout points. That's how bears are making money in this trend, and bulls are making money buying the pullbacks that are being caused by the bears selling and scaling in higher. So, the bears, let's say they sell above 42 and they see this and they're a little disappointed that it wasn't a bear bar, and they see this and they're selling the close and they're selling above this bar. And then you get this, and bears are going to start scalping out somewhere down here, and bulls are going to buy below the bottom of the bull spike, knowing that this is probably strong enough for a second leg up. And they're doing something reasonable. The bulls who bought this close did something reasonable. So 60% chance they're going to be able to get out around break even, probably at least getting back to this low. 80% chance, they're going to be able to get out the midpoint between this close and the next reasonable bull bar, which ended up being a little while later. So there wasn't much left, but bulls are going to be buying down here on limit orders for those reasons. You can see we ended up getting that vacuum test of the measured move up, like I was talking about. Micro channels are pretty common at the end of channels in general. We had another example of that over here on Thursday. This was a stronger one, but we got a micro channel at the end of a channel. And when that happens, a lot of times the pullbacks can be pretty deep because traders start to see the micro channel and they just pull their stop below every single bar, not wanting to give up a lot of profit if we start to turn down. Because if it is, this looks more like a trading range day, so you can get a pretty quick move. Get a quick move, you can get a quick move, you can get a quick move. So traders don't want to give up much profit, and traders not wanting to give up much profit and selling out quickly is exactly what causes quick moves. And so you can see once you get the doji bar on 55, when we trade below it on 56, traders immediately start selling out of their longs, and that's what's causing 57, 58, 59, 60. It's just bears or bulls selling out of their longs, being disappointed. Some bulls would be hoping that we were going to get a second leg up because the micro channel was pretty strong, but they continue to give up below each bar, and that causes the move down to the moving average. You're at the moving average, probably buyers. This has been a pretty tight channel, so it's probably going to get a second leg up. Bulls buying up here, maybe bought the close of 54, or you can see even if they bought above 54, disappointed 55, they were let out at break even on 56. So not as many magnets up here as you would like. If you're a bull buying down here, and you get an outside bar on 60 and an inside bar, outside bar on 61, inside bar 62. So it's an IOI pattern. And it's a doji bar on 62, but probably an okay swing buy. And if you get bad follow through, just get out. But you get great follow through on 63. Traders buy the close of 63, and you can see the 64 low never touched the overlapped with the 61 high. which is important because traders who sold above 61 and scaled in were not able to make money. And you can see at the end of the day, that's what we were trying to test. But we ended up getting good follow through to the upside. But you know that traders who sell above 55 are probably going to make money. And you get this doji bar, and you get a doji in a buy the close trend, you know that, it's probably going to end within a couple of bars, especially after, it's a pretty protracted bull leg in general. And then you get an II, and traders are going to exit below, get 3 pushes down and a reversal up on 75. You can see we essentially test the high close on 78. That's it. I think these days are really hard. Kind of suck for swing trading because there's no real, a lot of the swing trades, when they go against you, they go against you fast. And when they go for you, they go for you in a really slow way that's difficult to manage. So yeah, these days are just really difficult. On the daily chart, we have a couple bull bars, but we're probably going to end up going a lot more sideways rather than straight up. It's possible we get a vacuum test of the moving average like tomorrow or something, but it's very low probability. It's more likely we're going to get a vacuum test of this low. I think that's more important at this moment in time. But I wouldn't be betting on a bull close tomorrow. We've had a couple of bull bars and a reasonable pullback, and we have tested this low. We might have to get here, but I think it's likely that we're going to start going really sideways within this range. On the weekly chart, I mentioned last week I was surprised that the Bears got a really strong follow through bar, and I thought it was likely that they would end up being disappointed in the following week's follow through. And so far, those traders have been extremely disappointed in the follow through with this big bear bar, and it's looking like 3 pushes down and maybe a bull inside bar for a swing. I don't know if we didn't, never mind. But yeah, that's today.